Let's bring in Lisa Erickson, co-head of the Public Markets Group at U.S. Bank Wealth Management. Lisa, a little bit of a comeback. It feels a bit tentative, given back some of last week's rally in the S&P this week. On the other hand, we got these late-day rallies, some people making the case that a decent low might be in. How does the risk-reward seem to you, given we did almost a 20% decline, valuations have moderated a bit since the start of the year?
Well, good morning. And we're still modestly cautious on the U.S. stock market. To your point, we've had some declines. But as we look forward, we still have some question on the fundamentals. And really chief among that is the fact that we continue to have a Federal Reserve that really is intent, obviously, on combating inflation. And so you've got that tightening monetary and liquidity environment in front of us. And on top of that, as we look at the earnings picture, certainly with very tough comparables from last year, as well as just some slowdown that we're seeing in the macroeconomic front, they've got a headwind as well. So that's really leading us to a little bit more of a cautious stance.
Obviously, don't fight the Fed became a cliche for very good reasons over the years, and it's been the right strategy, largely speaking, this year. I guess the big question is, once the market has been down, let's say in one of these deep corrections, borderline bear market near 20%, the key determining factor historically as to whether it gets a lot worse from here or not is a recession on the horizon. And do you have to make that call? And are you able to have confidence which way it's going to break?
Our base case on recession really is that the chances are lower in 2022. The reason for that really is if you look at where we're starting from, while, again, there is decelerating economic activity, we're starting from a relatively solid base. If you look both at the consumer and corporations, they're very relatively healthy. And the absolute level of many indicators are still in growth territory. And then finally, if you think just about how Fed policy acts, there is a lag effect. It takes several months really to kick in. So I think that all bodes for 2022, still in a slowing economic environment, but hopefully avoiding recession. I think the open question now becomes what happens in 2023.
And then what do you do in terms of positioning for that type of environment, that sort of late cycle, but not yet recession?
So we're more sector balanced right now across the U.S. equity market, but within each sector, we really think a focus on more defensive, higher quality types of companies really make sense. So we would be favoring, for example, larger cap companies over small, those with stronger competitive advantages and recurring cash flows, more minimal debt levels. So we really think those kinds of exposures will help to carry portfolios through this more difficult time.
Yeah, it seems like that idea that sticking with quality has had a lot of adherence, makes a lot of sense right here. Lisa, thank you very much. Appreciate it.
Thank you.